The modern banking system operates on a principle that confuses most people because it seems to contradict common sense. Yet it is the foundation upon which all contemporary economies function. This principle states that banks do not primarily lend out money that has been deposited with them. Instead, they create new money through the act of lending. When you walk into a bank and request a loan, the bank does not shuffle through a vault to find cash that belonged to previous depositors. Rather, the bank performs a few keystrokes on a computer, credit appears in your account, and simultaneously, a matching liability appears on the bank's balance sheet. This is not deception or fraud. It is the intentional design of the modern financial system, and understanding how it works reveals why credit plays such a powerful role in economic growth, and why central banks focus so intensely on controlling interest rates and the money supply. The mechanics of money creation through banking begin with the concept of fractional reserve banking, a system where commercial banks hold only a fraction of their customer deposits in reserve while using the remainder to make loans and investments. Before the 2020 changes to banking regulations, the Federal Reserve required banks to hold a certain percentage of deposits as reserves, typically around 10% for most transaction accounts, though this percentage varied based on the size and type of bank. After March 2020, the United States eliminated the reserve requirement entirely, though banks maintain liquidity requirements and capital adequacy standards that effectively serve similar purposes. The reserve requirement was never meant to be a hard constraint on lending, but rather a safety mechanism to ensure banks could meet withdrawal demands and maintain operational stability. When you deposit $1,000 into a commercial bank, the bank records this as both an asset and a liability on its balance sheet. The asset is the cash you provided, and the liability is the obligation the bank owes you to return that cash on demand. However, the bank does not keep that entire $1,000 sitting in a vault. Instead, the bank keeps only the required fraction, such as $100 if the reserve requirement were 10%, and uses the remaining $900 to make loans. This process is where money creation begins. When the bank issues a $900 loan to a borrower, it does not hand them $900 in physical cash from your deposit. Instead, the bank creates a new account in the borrower's name and credits it with $900. This $900 did not exist before the loan was issued. The borrower now has $900 of new money to spend, while you still have your original $1,000 in your account. The total money supply in the system just increased by $900. The borrower spends this $900 at a local business, perhaps purchasing equipment for a startup venture. The business owner receives the $900 and deposits it into their own bank account. Now a second bank, or possibly a different branch of the same bank, records this $900 deposit. Following the same fractional reserve process, the second bank keeps $90 in reserve and lends out the remaining $810 to another borrower. This $810 loan again represents the creation of new money, because the new borrower now has funds that did not exist before, and the business owner who originally received the $900 still has a claim to it in their bank account. This process continues cascading through the financial system. The $810 loan gets spent, deposited elsewhere, and $81 are held in reserve while $729 are loaned out again. Each iteration creates fresh money through the lending process. Mathematically, this creates what economists call the money multiplier effect. If the reserve requirement is 10%, which means banks lend out 90% of deposits, the money multiplier is 10. This means an initial deposit of $1,000 can theoretically support up to $10,000 in total money supply across the banking system through successive rounds of lending and redepositing. The multiplier is calculated as the reciprocal of the reserve ratio, 1 divided by the reserve requirement ratio. However, this theoretical maximum is never reached in practice because some people withdraw cash from the system, banks hold excess reserves beyond the minimum requirement, and interest rates and economic conditions affect lending behavior. The process is further complicated by central bank operations. In reality, the money supply consists of multiple layers. The monetary base, also called M0 or high-powered money, includes physical currency in circulation, plus the reserves that banks hold at the central bank. This base money is the ultimate anchor of the system. It is the money that only the central bank can create. When the Federal Reserve conducts quantitative easing, it purchases government securities and mortgage-backed securities from banks and other financial institutions. In exchange, the Federal Reserve credits the bank's reserve accounts at the Fed with newly created base money. This base money never circulates in the general economy. It exists only in accounts that banks hold at the Federal Reserve. However, this injection of reserves into the banking system enables banks to make more loans, which creates more broad money in the form of deposits. Broader measures of money supply include M1, which encompasses physical currency plus checking account deposits, and M2, which includes M1 plus savings accounts, money market funds, and other highly liquid assets. Research from Johns Hopkins University indicates that commercial banks generate approximately 80% of the broad money supply, while central banks contribute only the remaining 20% through the creation of base money. This fact reveals the true source of money creation in modern economies. It flows primarily through bank lending, not through central bank printing. The relationship between base money creation by the central bank and broad money creation by commercial banks is mediated by the money multiplier, which varies over time based on economic conditions, interest rates, and the behavior of both banks and depositors. During normal economic times, the money multiplier might be around 2 to 3, meaning every dollar of base money supports $2 to $3 of broad money through the lending process. However, during financial crises, the multiplier can collapse. After the 2008 financial crisis, the Federal Reserve conducted 3 rounds of quantitative easing, injecting trillions of dollars into the monetary base. Yet the money multiplier fell sharply because banks, facing severe uncertainty and regulatory pressure, refused to lend aggressively. They accumulated excess reserves instead of deploying capital through loans. Similarly, during the COVID-19 pandemic, despite massive quantitative easing by the Federal Reserve and other central banks worldwide, the relationship between base money and broad money became distorted as banks and individuals engaged in precautionary hoarding of both reserves and cash. The regulation of money creation through banking is complex and multifaceted. Banks cannot create unlimited money without constraints. They must comply with capital adequacy requirements, such as the Basel III standards, which mandate that banks hold a certain ratio of capital to their risk-weighted assets. These requirements ensure that banks have sufficient financial cushion to absorb losses without becoming insolvent. The higher the capital requirement, the less leverage banks can apply, which means they can make fewer loans relative to their capital base. In 2025, regulatory changes have enhanced bank lending because the relaxation of capital requirements allowed banks to increase their lending capacity relative to their equity. Banks must also maintain liquidity ratios, which ensure they have sufficient liquid assets to meet short-term obligations without fire-selling assets at unfavorable prices. Banks face stress testing by regulators, which involves hypothetical scenarios where banks must demonstrate they could survive severe economic downturns without requiring government bailouts. All of these regulatory mechanisms constrain the pace and extent of money creation through banking. Central banks influence lending through interest rate policy. When the Federal Reserve sets its federal funds rate, it directly impacts the interest rates that banks charge on loans and the interest rates they pay on deposits. Lower interest rates encourage borrowing because loans are cheaper to repay, which stimulates bank lending and money creation. Higher interest rates discourage borrowing and reduce the incentive for banks to lend aggressively. Since the Federal Reserve lowered interest rates to near zero in March 2020 and kept them there until March 2022, banks faced powerful incentives to lend. However, banks also respond to economic uncertainty and credit conditions. If banks perceive elevated risk in the economy, they tighten lending standards, even when interest rates are low. This was evident in 2023 and 2024 when the Federal Reserve's aggressive interest rate increases from 2022 through 2023 caused significant losses on bank balance sheets for securities purchased at lower yields. Bank earnings and capital positions improved in 2025, leading to a resumption of more aggressive lending as the senior loan officer opinion surveys indicated. The process of money creation through banking creates both opportunities and risks for the economy. On the positive side, the ability of banks to create money through lending finances, economic growth, business investment, housing purchases, and entrepreneurial ventures. When Adam borrows $10,000 to start a business, he creates real economic value by building a company that employs people, provides products or services, and generates income. The money creation that financed this venture is not extracted from anyone else. It is genuinely new money that enables new economic activity. Without this money creation capacity, economies would stagnate because the supply of capital would be artificially constrained by the amount of physical currency in existence. On the risk side, uncontrolled expansion of bank lending creates asset bubbles and inflation. When banks lend aggressively, the increased money supply bids up prices of assets, including real estate, equities, and commodities. During credit expansions, investors become optimistic and bid asset prices to unsustainable levels based on expectations of perpetual growth. When those expectations reverse, asset prices collapse, borrowers default on loans, and banks fail. This dynamic played a central role in the 2008 financial crisis, when aggressive lending in the mortgage market created a housing bubble that eventually collapsed, triggering a cascade of bank failures. The relationship between credit growth and inflation is also critical. Research suggests that when bank loan growth consistently exceeds 6 to 7% annually, it typically generates inflationary pressures that overwhelm productivity growth. The Federal Reserve's policies from 2020 through 2024 provide a historical example. When the Fed reduced interest rates to near zero and conducted massive quantitative easing in 2020, banks expanded lending rapidly despite the COVID-19 lockdowns causing economic contraction. Simultaneously, government fiscal stimulus pumped money directly into consumer accounts. The combination of rapid money creation through both banking channels and government spending channels created a sharp increase in money supply growth that far exceeded productivity growth. The result was inflation that rose above 9% in summer 2022, the highest in 4 decades. The destruction of money through the financial system occurs when loans are repaid. This is the inverse of the money creation process. When a borrower repays a loan, the bank removes the deposit from the borrower's account, and the matching loan asset disappears from the bank's balance sheet. The money supply contracts by the amount of the loan repayment. If an economy experiences a period where loan repayments exceed new lending, the money supply shrinks. This contraction occurred during the 2008 financial crisis and contributed to the deflationary pressures that threatened the economy. As borrowers defaulted on mortgages and other loans, and as banks became unwilling to make new loans, the total stock of outstanding loans declined, which meant money was destroyed faster than it was being created. The Federal Reserve responded by conducting quantitative easing, which injected new base money into the system in an attempt to offset the money destruction occurring through loan defaults and the credit contraction. The financial crisis of 2008 revealed how central to bank lending the modern economy really is. When the banking system experienced a crisis of confidence and depositors feared bank failures, banks became unable or unwilling to lend. The supply of credit froze, which meant the normal process of money creation through banking halted. Without new money creation through lending, and with money being destroyed through loan defaults, the economy entered a severe contraction. The Federal Reserve's response involved multiple mechanisms: reducing interest rates to zero, conducting quantitative easing through massive asset purchases, providing emergency credit facilities to prevent bank failures, and coordinating with other central banks to maintain international financial stability. These interventions successfully prevented economic collapse, but at the cost of a severely disrupted financial system and the longest recovery from a recession in modern history. Understanding how banks create money through lending reveals why financial regulation is so important. If banks were unregulated, they could potentially create unlimited money through lending, constrained only by their capital base. This would lead to rapid inflation, because the money supply would grow much faster than the real economy's capacity to produce goods and services. Conversely, if banks were heavily restricted in their ability to lend and create money, economic growth would be severely constrained because businesses and individuals would lack access to the capital needed for investment and expansion. The regulatory framework attempts to strike a balance, allowing banks to create money at a pace that finances real economic growth without generating runaway inflation or financial instability. The modern understanding of how banks create money emerged gradually through the 20th century. Classical economics taught that banks were merely intermediaries that transferred savings from lenders to borrowers. But by the time of the 2008 financial crisis, it became clear to most economists and policymakers that this model was fundamentally wrong. Banks do not primarily intermediate existing savings. They create new purchasing power through the lending process. This recognition has profound implications for how we understand monetary policy, inflation, financial stability, and economic growth. The role of banks in money creation will continue to evolve as technology changes the financial system. Digital currencies issued by central banks, known as CBDCs, may eventually challenge the exclusive right of commercial banks to create broad money through lending. Cryptocurrencies and stablecoins exist outside the traditional banking system and represent alternative forms of money creation and exchange. Yet for the foreseeable future, commercial bank lending remains the dominant mechanism by which modern economies expand their money supply and finance growth. Every loan a bank makes is an act of money creation. Every default and repayment is an act of money destruction. The balance between these processes, managed by central banks through their control of interest rates, reserve requirements, and regulatory oversight, determines whether an economy experiences sustainable growth or faces the risks of inflation, deflation, or financial crisis. The system is neither natural nor inevitable. It is a human creation designed to efficiently allocate capital and finance economic development. Yet because it is so fundamental to how modern economies function, it demands constant management, vigilance, and careful balance to ensure it serves the common good, rather than collapsing into financial instability or generating destructive inflation.